Based on most of the financial data and projections I look at, the next decade is unlikely to be as good for retirees as the past. It might be a pretty rough financial decade. Goldman Sachs recently came out with a piece projecting 3% returns per year for the US stock market over the next decade. That would be amongst the lowest returns in history. Not great news for retirees. Now you compare that to the past decade. You've had strong US stock returns, relatively muted inflation. On average, tax rates even went down a little bit. It's been a pretty great financial decade for retirees. In this video, we're going to break down why the next decade might be a little bit more challenging and what you can kind of do or at least think about to prepare yourself for it. My name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. Now, first of all, let's just think about the past decade. Stock market returns have been pretty incredible. If you look at a chart of the S&P 500, I mean, from 2013 through Q3 24, the stock market has returned about 14.3% per year. That is a really phenomenal return. The S&P 500 has gone from about 1,500 all the way up to nearly 6,000. You know, if you take the time period from 2014 through 2024, you're looking at about 13% annualized stock market returns for the US. Anyway, you slice it, really good decade. If you think about historical stock market returns, just round to 10%, we've been steadily outpacing that the past decade. Inflation, meanwhile, if you take inflation like consumer price index, CPI, from 2014 through Q2 of 2024, annualized inflation has been 2.7%. Now, historically, that's been closer to 2.93%. So even with the high inflation in the last few years, inflation on average the past decade has been relatively normal and in fact even better than average. Finally, I mean, you take taxes, the Tax Cut and Job Act for the average American did reduce tax rates. Now, your mileage may vary depending on your individual situation. You know, on just about any metric, things have been pretty good for retirees the past decade. So why might the next decade be more challenging for retirees? I mean, I'm going to start with, I think, projected equity returns for US stocks are going to be much lower. We'll start with Goldman Sachs forecast. So they are projecting, if you look at this chart, this shows their model and what it projects for 10-year forward returns versus what they've historically been. It's actually, at least in the past, it's had quite tight correlation. They are forecasting a range of -1% to 7% equity returns over the next decade, with their baseline being 3% forecasted return. 3% returns would be in the bottom 10%, even lower, I think, of our historical returns. So when you look at this Goldman Sachs forecast and historical returns, you're really seeing the only periods that were negative were ending in 1940 and 2010, both of those coming off of 1929 collapse and the tech bubble collapse of 99. So when you get low single digit or negative returns, it's typically been in some pretty horrific environments, but also those environments typically started in really good environments, high growth, high equity valuations, everyone excited about the economy. Kind of has some echoes to today's environment. Now, I think, there's been a lot of hand wringing over this, people maybe dismissing it, but I think this is something retirees should really pay attention to. And really any investor should pay attention to, because if you look at a lot of other metrics that have correlation with future returns, they are painting a similar picture. So first of all, let's break down the Goldman Sachs. How did they get their forecast? They take 5 different metrics. So cyclically adjusted PE, also known as CAPE, that's basically how expensive is the stock market. Then they look at market concentration. Today it's really high because we've got a few huge mega cap names leading the way, becoming an increasingly large component of the overall index. They look at recession frequency, 10-year US Treasury yields, and finally the S&P 500 return on equity. Now, one of the things I think is interesting about their whole forecast, not to get too wonky here, but if you look at kind of what they present, these adjusted T-stats tell you how strongly correlated or how statistically significant some of these variables are. A T-stat, a little over, around 2 is where you get pretty significant. All of these, I think, are statistically significant, but the further the number from 0, the more statistically significant it is. And you can see a lot of these are just right around 2. With the lone exception of CAPE. So valuation at that -6.1 has the strongest correlation to future returns. And I think that's important because that's the metric that I think paints the scariest picture in the stock market today. So if we look at another way of forecasting future returns and we focus just on that CAPE ratio, and there's tons of other ones that do this and they all paint the same picture, you're gonna get projected stock market returns between -2% and 2% over the next decade. So again, just kind of another piece of evidence saying, oof, stock market returns, at least for US equities, are not likely to be all that good in the next decade. Even if they outperform this, let's say it's at the upper end of Goldman Sachs range at 7%, I mean, that's almost half the return that we've got in the past decade. Again, if you look at 2013 through Q3 of 24, it was 14.3. So that would be half the returns the next decade. So on this metric, it's clearly not looking very good. I think another aspect that people should look at is, if you take today's, say, deficits or debt levels, it's in a concerning environment. We've got debt to GDP levels that we've basically only seen coming out of World War II, and the country was in a much different environment back then. If you look at our current federal deficit as a percentage of GDP, we're at a level typically only seen in recessions or war. The fact that we're at this level in a expanding economy is a little mind-boggling. Why I bring that up is I think that points to a future of either higher inflation or higher taxes, neither of which are going to be good financially for retirees. If you look at the history of the highest marginal federal income tax rate, income tax rates today are pretty low relative to where they've been historically. It doesn't take a real leap of the imagination to envision tax rates going up. In fact, the Tax Cut and Jobs Act a lot of the provisions are set to expire at the end of 2025. So that had been a big tailwind for retirees the past decade. It doubled basically the estate and gift tax exemption. And that is set to go away at the end of 25. So barring any legislative changes, that's going to present some estate planning challenges for high net worth individuals. And again, just based on kind of the math, at some point in the future, will it happen in the next decade? I don't know. But at some point in the future, tax rates are very likely to go higher. And it's not just tax rates I think can go higher. And, there's a risk of inflation being higher. It's been higher in the last few years. It's currently sitting in the 3 to 4% zone. That's going to be higher than both historical and higher than the past decade. So I think the lone bright spot for retirees is that beginning treasury yields are significantly higher today than they were a decade ago. So you can get a reasonable alternative. And that does kind of bring me to my point is, what do you do about this? If you look at this, you say, gosh, I think my equity returns are going to be lower. I think inflation might be higher. I think taxes might be higher. How do I prepare? I think a couple things. You start with looking at your financial plan. Have you kind of run it through the paces? Can it survive lower equity returns than maybe your baseline projections? Are your projections too high? If you're banking on 10% returns, what happens if your returns are 2% the next decade? What does that do to the plan? The other thing is, to the extent you're able to be dynamic in asset allocation, I am drastically underweight US equities for most of my clients today, mostly because I believe in some of these forecasts. I think the kind of yields you can get in bonds are likely to perform US equities over the next decade. I think emerging market and international are at far more attractive valuation levels. So having maybe a non-traditional asset allocation is something to consider. Running through your planning, what can you do there? Just kind of being mindful of how inflation might impact things, being tax aware. Is there any kind of opportunities you can take advantage of? Things like Roth conversions. So just kind of looking through your plan and making sure everything is really buttoned down and that you can survive a little more adverse scenario. And certainly don't just project out what has happened the last decade. I think we're not going to see what we've seen the last decade. In fact, as these projections show, you probably see lower than average returns. So hope this video gave you some food for thought and you enjoyed it. Appreciate it if you like it. Subscribe to my channel and share with anyone you think would benefit. Appreciate you tuning in today.